Thank you for joining us for this quarter's Compliance Bootcamp webinar, More to Compliance Than the ACA. Please note, the presentation slides will be emailed to all participants by tomorrow. At the bottom of your screen, you'll see several widgets for your use during the presentation. For example, if you have a question, please click the purple Q&A icon to the left. At the end of the session, we would love for you to complete our brief survey by using the teal webinar feedback widget. You will also be able to download your SHRM and HRCI credits. Speaking today is Dan Cooperstein, Senior Vice President of Compliance at Corporate Synergies. Corporate Synergies is a national insurance and employee benefits brokerage and consultancy where Dan is a respected thought leader on healthcare reform. He has published many articles and videos on the Affordable Care Act and other laws and regulations, which can be found in the Knowledge Center on corpsyn.com. Dan is an ERISA attorney with experience in a broad array of sophisticated employee benefits and labor and employment matters, including the ACA, COBRA, HIPAA, and GINA compliance. At this time, I will turn it over to Dan.
Great, thanks Ashley, and welcome to More to Compliance Than the ACA. While the ACA and the many efforts to reform it seem to be getting all of the attention in the news lately, when it comes to health and welfare plan compliance, many of the most interesting and impactful developments that are happening right now are happening in the world of ERISA and HIPAA. Also, when it comes to helping clients across the country with their health plan compliance issues and questions, it just seems that the majority, at least a lot of questions, perhaps a majority of them that we're getting these days are related to ERISA or HIPAA. So naturally, that's where today's title comes from, and we'll be talking about those ERISA and HIPAA developments as well as mental health parity developments and some new guidance that came out from the DOL and the IRS in the aftermath of Hurricanes Harvey and Irma. And then finally, at the end of today's presentation, even though this is a presentation about everything but the ACA, we'll be doing a very, very brief update on the most recent developments pertaining to the Repeal and Replace Initiative, just to give everyone an update as to what's been happening with the ACA since our last webinar in June. So let's go ahead and get started, and by talking about some of the more significant ERISA developments that have been happening. And so many of these recent developments, these are the topics we're going to cover in this first section about ERISA, and you can see so many of these big developments that have been happening recently are in the area of ERISA plan document compliance. And so we're going to start off this section really talking about some of these recent court decisions about plan document compliance and what you have to do for your plans. Then we're going to talk about some recent DOL penalty increases that you need to be aware of. We're going to talk about some DOL guidance on MIWAs, or multiple employer welfare arrangements, that came out earlier this year. And then we're going to talk about the DOL claim and appeal regulations for disability plans that will be going into effect in 2018. So this first picture, this is actually a picture of my bookshelf actually in my office and all the cases that I had to read in the last week to prepare for this webinar. A lot of cases, just kidding, I'm really just kidding, that's just a picture. But there were a lot of cases that came out that really, that really important for us to read, especially here where we do so much drafting of plan documents and amendments and SPDs. It's really just something that that we're really involved in. And I know if you look at this next slide here, you see a lot of legalese on the page, but don't get nervous because we're going to break down each of these cases into very simple stories that really explain what you need to do to make sure that your health plan is in compliance. And so with that being said, let's go ahead and get started with this first case, this case called Matthias that was decided on August 10th of 2017. And in this case, an employee was participating in his employer's long-term disability plan, and this participant, he sued the plan for wrongful termination of his benefits. And the plan document said that you can only bring lawsuits in Illinois. And just to provide a little bit of background here, this part of the plan document that said it can only the cases can only be brought in Illinois is referred to as the plan's venue provision or forum selection provision, and it's a common feature of ERISA plan documents. So in any event, the employee filed his lawsuit about the termination of his benefits in Pennsylvania saying, look, I have a right to file a lawsuit in Pennsylvania because I live and I work here. The employee claimed that it was against ERISA's venue provision for him to have to go to Illinois to bring a lawsuit since he lives and works in Pennsylvania. Well, in this case, the plan actually was administered in Illinois, and the employer's headquarters was in Illinois. And just to provide a little bit more background about ERISA's venue provision that he was saying he had a right under, ERISA's venue provision allows a lawsuit to be filed in the court where 1, the plan is administered, 2, where the breach of the plan's terms took place, or 3, where the party that's being sued resides. So any of those options is okay for a plan to draft a venue provision for. So in any event, the bottom line here was that the court ruled in favor of the employer, finding that the employer's plan document, which required the lawsuit to be brought in Illinois, was enforceable, meaning that the venue provision of the plan was compliant, because it complied with this ERISA's venue provision. It only needed to have one of those 3 parts of the ERISA venue provision included in the plan document to be enforceable. And in this case, since the plan document clearly said Illinois, and Illinois was where the plan was administered, the court upheld and enforced the plan document. So what's the key takeaway here if you're an employer drafting a plan document? Well, the first thing is always draft a venue provision that is consistent with that ERISA venue provision, right? Meaning that the venue or the location of the court that you reference in your plan document has to be one of those 3 places that's listed in the statute. But also you should think about practical considerations when you're doing this as well, right? I mean, think about your company, right? Where is your company located? All of your in-house counsel at your company could be admitted in New Jersey. Your primary go-to law firm could be in New Jersey, and your headquarters could be in New Jersey. If that's the case, you don't want to make a venue provision in Delaware or California. So the key takeaway here is just use common sense. But ultimately, the bottom line is that this is a decision that's favorable to employers, and it's a big win for employers at the end of the day, especially those that really employ a careful drafter. Okay, so let's look at this next case. Let's actually mull over this next case, Mull v. Motion Picture Industry Health Plan. In Mull, this is a case about a participant's family member who was a dependent on the health plan, and the dependent was injured in a car accident, and the plan loaned her money. In fact, it was a lot of money. It was $147,000. And when it came time to pay the money back to the plan, the dependent and her family said, well, you know what, we're not going to pay it back to the plan. She actually recovered the money in a personal injury lawsuit, said, I'm not going to pay it back to the plan since the plan does not have a legally enforceable recoupment provision, since there's only language about recoupment in the SPD and not in the plan document. In fact, there's no plan document, there's just an SPD. That's what was alleged by this dependent. So the court ruled in favor of the plan and the employer, saying that even though there's no formal plan document and there's just an SPD, the SPD refers back to a trust agreement as a part of this plan. And then the court also took a look at the trust agreement and saw that in the trust agreement it incorporated the SPD in its terms. So the court determined that the trust agreement and the SPD together constituted the plan and therefore satisfied the requirement under ERISA referred to as the written instrument requirement. And what that means in plain English really is just that there has to be a written plan document and an SPD that constitute the plan and that provides certain essential information to plan participants under ERISA in order for the plan to be in compliance with ERISA. And so you might be saying, well, that's strange. There has to be a plan document and an SPD, and here there was just a trust agreement and an SPD all kind of incorporated into one document. How did the court allow that to be the case? Well, they really just looked at the fact that there was so much reference between each other, right? So the SPD referred back to the trust agreement referred to the SPD, and so to the court it was clear that this constituted one plan. So what's the key takeaway here? Well, this case and the case that we're about to discuss next in the Fifth Circuit, they're really giving legal credibility to the idea that it's okay to have one document that constitutes both the plan document and the SPD. And while there are some law firms and insurance brokers that provide these single documents, plan documents, many courts for a long time had said, well, these single doc, plan doc / SPDs, they're not compliant because how can the SPD, which is designed to summarize the plan document, summarize itself, right? It doesn't make any sense. It it can't all be in one. And that was really what a lot of courts had said for a long time. And it's a great question. So let's take a look at that other case that happened in the Fifth Circuit, the case of Ray v. Allen Ritchie from May 30th of 2017. And in this case, we have the same issue. We have an injured plan participant with loaned money from the plan. He doesn't want to pay the money back to the plan that the plan loaned him. And in this case, there's even more problems with this single document plan doc/SPD document, since here, in the facts of this case, the SPD refers back to an imaginary second document that doesn't exist. In fact, it refers to a, quote, an official plan document, and yet there never was any such document. And then, interestingly, the court rules in favor of the plan and the employer, saying that the SPD was specific enough, it had, quote, sufficient detail on its own to constitute both the plan document and SPD, even though they were both in one document. And what about that imaginary document that the SPD referred to, the official plan document? Well, the court said it's just sloppy drafting, and it doesn't rise to a breach of fiduciary duty, nor does it render the SPD unenforceable. So what are the key takeaways here, really, for employers? Again, you know, the trend here is that it may actually be okay now to have both the plan document and the SPD all together in one document, even though this is not how many courts have interpreted the ERISA written instrument requirement in the past. So if your company has one of these documents, these single document plan docs, you know, you may be okay, and you may now have a couple of federal court decisions to support you in the argument that this is a compliant document. Okay, so let's talk about this last case, and this California law case that bars discretionary clauses. And so while we're still trying to do story time here and make, you know, avoid all the legalese as much as we can, we do have to understand a few legal terms here with respect to this last case, just to kind of understand what the case is about. And the key legal term here to understand is, quote, discretionary clauses, right? The discretionary clause of the plan document. So what are these things? Why are these so important? And what do they mean in the context of ERISA? Well, for nearly 3 decades, ERISA plans have routinely included a provision that grants plan fiduciaries unfettered discretion to interpret and rule on issues concerning the plan's interpretation through these discretionary clauses. And when a plan fiduciary interprets a plan provision and the issue of that interpretation ends up in court, if the plan document has one of these discretionary clauses, then the court is supposed to grant what is called deferential review. And deferential review, that's just a legal term that means that the court gives it a lot of weight and deference, gives the decision of the plan fiduciary a lot of weight and deference. And in other words, if the plan document contains one of these discretionary clauses, the court only reviews the fiduciary decision to see if the fiduciary abused her discretion. And otherwise, if she didn't, the court will uphold the fiduciary's decision. So a lot of weight is given to the fiduciary's decision under deferential review. And these so-called discretionary clauses, well, they've been subject to a firestorm of criticism by many states. That the states have argued that the discretionary clauses lead to inequitable results for plan participants because the fiduciary of the plan gets to make all the decisions and the courts just accept it. And as a result, many states have enacted laws banning discretionary clauses in insurance policies. And what happened in this case, just to kind of go back to our story, in this case, California adopted one of these laws banning discretionary clauses. And for a long time, employers with operations in California didn't know if this law applied to them if they had a self-insured plan. They were pretty sure it applied if they had a fully insured plan, but if they had operations in California and they had a self-insured plan, they weren't sure if this law applied. Well, finally, this case gave us a lot of clarity. And what happened here was that a participant sued the plan after her benefits were denied under her employer's short-term disability plan. And the plan contained a discretionary clause, which would normally, and this was a self-insured plan, and the plan contained a discretionary clause which would normally result in deferential review by the court. But the court determined that the clause was made void by the California law, which, in other words, does not apply because of the state law barring such provisions. And the court gave non-deferential review, or de novo review, and ruled in the participant's favor, concluding that the plan's short-term disability benefit denial was improper. So what happens next? Well, the employer and the plan appeals, arguing that the court should have applied deferential review because the law barring discretionary clauses applies to insurance, and thus it does not apply to self-insured plans, essentially was referred to as a preemption argument. And then the court agreed with the employer and ruled that the California law barring discretionary provisions does not apply to self-insured plans. And so what are the key takeaways here, right? Well, if you have a fully insured plan and you're in California, the law does apply to your plan. So you can't use that discretionary language. But the good news is that the clarification it provided to sponsors of self-insured plans is something that they can use, right? Now you can use these discretionary clauses if you have a self-insured plan. And it's really just been a big relief to employers with substantial operations in the state of California. Okay, so let's talk a little bit about DOL penalty increases. I mean, so often we get this question here especially with prospective clients or clients that want to come in for a compliance assessment or mock audit. What are the penalties if my company hasn't done this, or if we haven't filed a Form 5500 for a long time? Well, those penalties went up. There was federal legislation that came out under the Obama administration in 2015 requiring the agencies to calculate inflation-based catch-up increases to civil penalties with annual adjustment thereafter. And the initial increases applied to penalties assessed after August 1 of 2016 for violations occurring after November 2nd of 2015. And the first annual adjustments were issued earlier this year, January 2017, for penalties assessed after January 13th of 2017. So what are some examples of the penalties that apply to group health plans? Well, Form 5500 filing violations have now increased to a maximum penalty of $2,097 per day. SBC failures, summary of benefits and coverage failures, increased to a max penalty of $1,105 a day, and GINA violations have increased to $112 per participant per day. So very substantial penalties could result if you're not doing those things and are not acting in compliance. Okay, so now we're going to talk about a couple of very interesting pieces of guidance that came out of the DOL from earlier this year on multiple employer welfare arrangements, or MIWAs. And our first case involves a dairy cooperative. So maybe we should call it a MUWA case. But in this case, a group of employers in a dairy cooperative, they asked the DOL if they have this loosely affiliated group of dairies that were operating in Minnesota and in Wisconsin, and they asked the DOL, do we have a sufficient association to constitute an employer association for purposes of setting up a MIWA under ERISA? And the DOL ruled that the answer is yes. And when it looked at all the factors, it said, well, look, they're in this consortium, it's a cooperative, and they're in the same industry, and they have a genuine relationship. All these different dairy farms throughout Minnesota and Wisconsin, even though they may seem like they're sort of disparate, loosely affiliated, they do have a genuine relationship outside of the context of just the benefit plan. So it was sufficient to, according to the DOL, this was a sufficient association to be considered to be a MIWA, or we should say MUWA, under ERISA. And the other DOL guidance we wanted to talk about was the a very kind of similar thing that kind of goes in the opposite direction, right? Here we had a group, this is a DOL opinion letter from earlier this year, where we had an association of members. These were self-insuring employers with ASO contracts, administrative services only contracts, that were connected together as part of this arrangement to get lower cost services, to analyze health plan data, and to negotiate favorable rates for access to insurance companies as networks. And when the DOL took a look at this and said, the question is this an ERISA welfare plan? And the other question the association had was, is this a MIWA? And the DOL took a look at the facts and said, no, it's not an ERISA plan, and it's not a MIWA, because the employers are not really acting in their capacity as employers providing benefits to employees here. The services that are offered are not benefits to employees. It's things that help employers, right? It helps the employers to analyze and better negotiate the terms of their health plans. It's not really something that impacts benefits, so it's not ERISA. and there was insufficient risk sharing among the different entities. They weren't really pooling risk in any way, so there was no real insurance risk sharing to constitute a MIWA. So very interesting opposite result there from the Department of Labor. Okay, so let's talk about the 2018 DOL claim and appeal regulations for disability plans that are going to be going into effect soon. And really, these were issued back in December of 2016 under the Obama administration, and we did an alert about this. We got a lot of questions about it. What really the big change here is that the current rules that are currently applicable to health plans that apply for claims for health plans are now going to be applied to disability plans. So these new regulations will be applicable to claims for disability benefits that are filed on or after January 1st of 2018. And what that really means is that all the requirements that you need to do under ERISA for your health plans, you now have to do for disability claims. So there's going to now be much more detail in claims denial notices for both initial claims and appeals. There's going to be criteria to ensure independence and impartiality in claims decision making. Most rescissions will be treated as adverse benefit determinations. Claimants now have a right to go directly to court, and the requirement to exhaust procedures internally will not apply if the plan's procedures do not strictly comply with the requirements of the new regulation. And the notices have to be provided under the same culturally and linguistically appropriate standard as the notices that are applicable to group health plan claims. So those are some of the major changes that are going to be happening. Now, for most plans out there, especially fully insured plans, the carriers are really going to be taking care of these notices. But if you have any involvement in claims, if you have a self-insured plan, or even really if you have a fully insured plan, you just definitely want to make sure that your insurance company has updated the claims notices and the claims procedures to make sure that they comply with these new requirements for claims that will be filed on or after January 2018, because especially if you're self-insured, the liability and the cost will be on you. Okay, so let's talk next about HIPAA. Now, HIPAA has been getting a lot of attention recently, particularly because of just these monumental settlements that have been happening recently, in the multi-million-dollar settlements between the Department of Health and Human Services, Office of Civil Rights, or OCR, and plans, but also just because of all the breaches that have been happening. And the thing is that even though this recent Equifax breach did not include PHI, it was financial information, there's just been a lot of focus and attention about HIPAA. So we're going to just kind of, in this section, just cover some of the big things that are happening, some of the biggest developments pertaining to HIPAA. And we're going to start talking about with, the health plan identifiers, or HPIDs, the recent development that happened there. Then we're going to talk about the status of the Department of Health and Human Services OCR Phase 2 audits. And then we're going to talk about some of those recent high-dollar settlements that have occurred in recent months. And then we'll finally talk about the new HHS OCR Enhanced Portal and some other developments pertaining to the hurricanes. Okay, so on June 21st, the big thing that happened with HPIDs, it's really news saying that there's no news is the best way to kind of summarize it. To provide some background here, there was these regulations that came out in 2012 about HPIDs, which are identifiers, they're 10-digit numerical identifiers that were going to be required to be used in HIPAA electronic transactions. And there were some regulations that came out saying that this would happen, this would go into effect in 2014, but just days before these new identifiers would be required to be used by large employers, large health plans, the Department of Health and Human Services said, no, we're not going to enforce this, we're going to delay this indefinitely, and nothing ever really happened. Well, recently on June 21st, the National Committee on Vital and Health Statistics, NCVHS, recommended to HHS, from their findings in a May 2017 hearing, to rescind their 2012 rules on HPIDs and continue their non-enforcement policy on HPIDs. And then subsequently, CMS, which is a sub-agency of HHS, recently updated its website to reflect these recommendations. And essentially what they're saying is that you don't need to use HPIDs because we have this other existing identifier called the payer ID, a shorter numerical code that's been voluntarily adopted by private industry, and it's sufficient to be used for HIPAA electronic transactions. If we had to use these HPIDs, the 10-digit ones, that would be disruptive, it would be costly, and counterproductive to administrative simplification. So bottom line here, again, like I said in the beginning, no news really, right? It just seems like the mandatory use of HPIDs in HIPAA electronic transactions is probably never going to happen, since it's just going to be delayed indefinitely and probably will never be a compliance requirement. Okay, let's talk about the HIPAA Phase 2 audit program. And what this was something that started under the Obama administration in 2016. It was going to be aimed at covered entities and business associates, really to make sure that they had policies and procedures in place and that they were following them with respect to HIPAA compliance. The first round of it happened in mid-July of 2016. Letters were emailed for desk audits of covered entities to 167 covered entities who were audited. And then the next phase of it was going to be desk audits of business associates. And just to clarify, desk audits are all online, all by email. So what happens is the HHS will send you, their Office of Civil Rights, or OCR, will send you an email saying, send us these documents to show us you have these policies and that you're complying with them. You send them the documents. It's all done without anyone ever having to come onto your premises as an employer. So, you know, they're a little bit easier than on-site audits. So anyway, in any event, round 2 comes out in late 2016. Letters were emailed out to business associates, and most of the TPAs were really being audited in the second round. And over 200 desk audits were completed in round 1 and 2. There was also, just to note, there was a phishing scam that occurred as a part of this on November 28th of 2016, where an email went out on official HHS letterhead. So it concerned a lot of people. But in any event, the first 2 rounds occurred, over 200 desk audits were completed. And then the third round was supposed to happen sometime very soon, but never happened. The third round was designed to be a much more comprehensive audit. It was supposed to be on-site and take between 3 to 5 days. And they said there would be a separate group of entities that would be selected, but there may be some overlap with those selected for rounds 1 and 2. It was recently indefinitely delayed by HHS, but some commentators out there are expecting it to commence in early 2018. So we're watching that very closely, and we'll keep you updated on that. And the real key takeaway here is that while there's a big expectation that the commencement of the Trump administration was going to be slowing the OCR's HIPAA audit activity, in fact, it's actually not been the case. The HHS is going forward full force on HIPAA compliance. They've continued at the same pace and with the same diligence as under the Obama administration. And the settlement amounts continue to go up and have been really astronomical numbers in recent months. So this is definitely a priority for the Trump administration and the Department of Health and Human Services. So we wanted to take a look at some of these really big HHS OCR settlements. These are actually technically called resolution agreements, and just get an understanding of what happened with them. And while we'll be talking about sort of the highlights of these developments and takeaways for sponsors of plans, we're going to do a much deeper dive next quarter on HIPAA compliance. We'll take a much closer look at these and what employers can do, how to put a plan together and a policy in place to protect yourself. So this is just really more of an overview, and next quarter we're going to do the deeper dive on this. Okay, so this first one we're going to look at, September of 2016, CARE New England Health System. It was a self-reported breach where they lost unencrypted backup tapes with PHI of 14,000 individuals. When the OCR did the investigation, they found an outdated business associate agreement from 2005. And as you may know, if you've been up to keeping up with this stuff, HIPAA was amended in 2013 by the high-tech law. So that business associate agreement did not include any provisions about high-tech, and that was a big problem for OCR. Definitely a reason for why you should come in, just to do a quick commercial for corporate synergies in our compliance assessments. That's something that we do for all of our new clients to come in for a compliance assessment. We review their business associate agreement, but that's an obvious error. The resolution agreement imposed a $400,000 penalty on the entity plus a 2-year corrective action plan. This next one was from October 17th of 2016, the St. Joseph Health System. There was a self-reported breach. 31,000 employees lost their EPHI. It was publicly accessible through the internet due to the settings of their new server's file sharing app. The OCR found inadequate security risk analysis by the entity. The policies and procedures were not updated for the new server and were not implemented enterprise-wide. The resolution agreement there was $2.14 million, and there was a 3-year corrective action plan. This next one, UMass, where the entity was operating as a hybrid entity, was very interesting. Here, there was malware that allowed impermissible remote access to the EPHI of 1,670 individuals without firewall protection, and the OCR found improper hybridizing within the entity, meaning that the entity did not properly designate all of the different healthcare components that would be able to use and access PHI. And additionally, they didn't implement policies and procedures and safeguards. There were some other problems. They didn't do a risk analysis until after the breach occurred. But the big thing here about the hybridizing issue is that this is extremely common with universities. And I know because we talk to a lot of universities and schools from across the country here, and oftentimes they're just not thinking about the fact that they are accessing and using PHI in so many different areas of the university. So for example, there could be a sports program at the university that has medical information coming in and out of that component of the entity, plus there could be a medical research center at the university that also has PHI coming in and out, and those all need to be taken into account within the policies and procedures of the entity. So it's something that is a common problem. Here the resolution, the penalty was $650,000 and a 2-year cap, but that's a common issue with universities. The other one was Memorial Healthcare System from February of 2017. Here we saw a self-reported breach where several employees impermissibly accessed patients' EPHI. The OCR found inadequate security access controls for EPHI and the entity did not terminate a former employee's login credentials, enabling other employees to access patient PHI without detection for a year. And interestingly, the resolution agreement here coincided with the release of the OCR's cybersecurity newsletter on the understanding the importance of access controls. So, some commentators out there said, well, this resolution agreement was really just, they're really trying to make an example out of this healthcare system. But what happened was really so egregious that it probably did actually really result in that penalty that was assessed. In this case, it was a $5.5 million penalty and a 3-year corrective action plan. And the 14 employees that were involved with selling the PHI of patients were criminally charged. So a lot of problems there. That's really, in many ways, like the worst case scenario. Okay, let's talk about this one. It's very interesting from April of 2017, CardioNet. And why it's so interesting is because this is the first time we see a provider of wireless health care services. So it's a wireless healthcare service provider, cardiac monitoring services. And here there was a theft of a laptop from an employee's car. PHI of 1,391 individuals were exposed. The OCR found multiple security compliance issues, inadequate risk analysis, and inadequate risk management plan. They did not have policies and procedures for encryption or movement of hardware and electronic media. And here the OCR imposed a penalty of $2.5 million and a 2-year corrective action plan. So I think it's interesting just because of the type of entity and just the fact that they should have known better, I think is the sense that I think some of the commentators I've heard on this one that, if you're in that business and you're providing wireless healthcare monitoring services, you really need to be on top of the stuff. Okay, so the next one from April 26, just 2 days later, Memorial Hermann Health System. Here we had an impermissible disclosure to the media, and the name of a patient who allegedly committed insurance fraud was sent to the media, and it should have been sent, instead of the media, it should have been sent to law enforcement. And here the OCR found that senior management approved the disclosures and the entity had not approved any kind of sanction policy as required by HIPAA. the OCR imposed a $2.4 million penalty and a 2-year cap. And obviously the key takeaway there is that, you know, if you're going to be doing something like, you know, if you're going to be making a disclosure, don't disclose to the media for something like this. You would disclose it to law enforcement first. So that's the obvious takeaway. And then finally, we have one HHS civil monetary penalty here. This is technically not a resolution agreement, but a monetary penalty of $3.2 million that was assessed against the Children's Medical Center of Dallas for the loss of an unencrypted, non-password protected device at an airport and the theft of an unencrypted laptop from the entity's premises. And here the OCR found an inadequate risk management plan and physical safeguards, the failure to address risks of unencrypted EPHI, and the continued issuance of unencrypted portable devices and storage media to employees despite prior incidents and warnings from consultants. So they knew what they had to do and they disregarded it, and they continued to act out of compliance. So all of these are reasons for why you should have your HIPAA compliance assessed and reviewed. You should do a HIPAA training for all of those individuals at your organization that will have access to PHI or EPHI. It's something that we can provide here at Corporate Synergies. Okay, so let's look at some other developments that happened recently with HHS. One of the first things that's interesting that happened in June was that the OCR came out with a whole bunch of new cybersecurity guidance, that including a new checklist that gives step-by-step instructions for covered entities and business associates to respond to cybersecurity incidents. So really helpful stuff. Definitely check it out on the HHS website. Also, in July of 2017, HHS updated its investigations portal, allowing people to access investigations that are going on. It's commonly referred to as the wall of shame. And they updated it by making it just more user-friendly. They added these 2 new categories that allow you to go back and look at any reported breach of unsecured PHI or EPHI affecting 500 or more individuals. And the categories were under investigation, so you could look at all the breaches that occurred in the last 24 months. And the other category was archived, so you could look at those that were older than 24 months. And really covers a pretty big period of time, and it's just much better than the old portal. In fact, we have a link on the slide to the portal if you want to check it out and make sure your organization is not on the wall of shame. But really kind of a cool development there from a compliance standpoint. And then, of course, in September, very recently, the Department of Health and Human Services issued Hurricane Harvey-related HIPAA guidance. That's like a lot of H's. And they clarified that the Secretary of HHS can waive certain provisions of the HIPAA privacy rule during a declared public health emergency, as we saw in Texas and Louisiana after Hurricane Harvey. And really there, that kind of really makes sense, right? That they can allow for PHI to be shared without having to comply with all of the privacy rules if it's relevant in emergency situations and to provide, for example, to provide urgent medical treatment or care in the event of a hurricane. Okay, so let's next talk about a little bit about mental health parity and some other interesting compliance developments that are going on. And also, like HIPAA, our next quarterly webinar is going to be on mental health parity as well, and the things that it's going to really do a much deeper dive than what we're going to be talking about today, which is just sort of a big overview and understanding of the key developments. So I definitely encourage you to check in for our next webinar on this. But what we're going to talk about today is some recent guidance that came out under the mental health parity laws and applying to the new law, the 21st Century Cures Act. And then we're going to look at a recent decision on EEOC wellness plan incentives. And then we're going to talk about some of the hurricane relief programs that have come out very recently. So when it comes to mental health parity guidance, this has always been probably one of the most challenging areas for employers and plan sponsors. And it kind of got even more confusing and challenging at the end of 2015 when under the Obama administration, the President signed the 21st Century Cures Act into law, which required all kinds of new rules pertaining to eating disorders and substance abuse disorders. And this guidance pertains to how the mental health parity rule laws under MAPIA apply to benefits that are offered for the treatment of an eating disorder, and it solicited comments to see if any additional clarification was necessary. And specifically, it said that plans covering treatment for eating disorders have to ensure that the financial cost limitations and treatment limits are not more restrictive than those for medical or surgical treatment. It also issued, as part of this guidance, a draft model form that participants and their representatives can use to either request information from their plan or their insurer regarding mental health or substance use disorder benefits, or obtain documentation after an adverse benefit determination that involves mental health or substance use disorder benefits to support an appeal. So they requested comments. It's not clear yet what they're going to do in the final regulation, so this is not the law yet, but it's probably going to become final soon. And really the key takeaway here is that while obviously this new guidance is helpful, and any new guidance that we can get on the mental health parity rules is extremely helpful, there's still a lot of employers out there that are really confused about how to apply the mental health parity rules to non-quantitative treatment limitations that are in these rules, and they're still extremely confusing. In fact, in late July, the American Benefits Council published their comments and said, we really want to see much more clarity on the guidance here with how employers can comply with the MAPIA's non-quantitative treatment limitations, including specifically the things that are required with respect to autism treatment. So a lot of questions still out there. A lot of employers still very confused about what they need to be doing. Okay, so let's talk also about other really big development that happened on August 22nd of 2017. And this was a case about wellness plan incentives. And just to kind of explain a little bit of background here, the AARP, which is the group you may have probably heard of that advocates on behalf of retired persons, brought a lawsuit against the EEOC alleging that their final wellness plan regulations that they issued under the ADA and GINA last summer in May of 2016, they were arbitrary and they were capricious. There was no real, they were basically saying that there was really no support for their findings that this 30% incentive cap was the correct number for an incentive cap. And they didn't believe that the explanation given that this would ensure that the plans were voluntary was real. In the view of the AARP, the incentives are still too high to give employees a meaningful choice about whether to participate in the wellness programs that requires, if the program requires disclosure of ADA protected information. So essentially the AARP is saying, look, the wellness incentives can still be way too high under these regulations, and we don't think it's giving our constituents, the people that we represent, adequate support and protection from access to their private information. So the court took a closer look at, well, what did the EEOC really do to support this? And the EEOC had argued, well, look, we based this 30% incentive cap on the incentive cap that's under the HIPAA rules as they were amended by the ACA in 2014. And since those use this 30% incentive cap. Well, the court didn't agree with that, right? The court looked at this and said, well, we're going to rule in favor of the AARP because there's really, the EEOC's basis for this 30% incentive cap is flawed. And it cited to a variety of different reasons, but one of the main things is that it said it does not align with the 30% incentive cap under HIPAA. And the reason for that is because there's just a lot of differences with how that 30% incentive cap is applied. So, for example, when it comes to the HIPAA rules, the 30% cap is applied to either the self-only tier of coverage or the family tier of coverage, depending on which coverage is applicable. Whereas under these EEOC rules, it's the maximum for the incentives is 30% of the employee-only tier, and that's the only tier that you can use. You can't apply it to the family tier. So it's not really the same. And there was really no support or reasons that were given by the EEOC for why they got this number. So what happened as a result was that the court vacated the final rules, or essentially rescinded them, and said, we want you to take these back and reconsider these rules and provide more support for how you got to the 30%. but it left the current regulations in effect until the EEOC can promulgate those new rules. So the key takeaway here for employers and sponsors of plans is that there's really nothing that you need to do right now because the status quo remains in effect until these new regulations, these new reconsidered regulations can be promulgated by the EEOC. And we also wanted briefly, just as one of the last things in this other development section, we wanted to talk about some of the big hurricane relief programs and the key points that are out there from the IRS and DOL. So one of the first things that happened on August 30th was that the IRS thought of tax extensions, right? That's what you're going to need if you're suffering from Hurricane Harvey. So one of the first things that happened on August 30th, they permitted extensions of various tax filings and payment deadlines starting on August 23rd of 2017. And the relief applies to Form 5500 filings and payroll and excise tax returns, but not to information return filings. So it will not apply to your Forms W-2, and it will not apply to your Forms 1094-C and 1095-C. If you are a Form 5500 filer that is relying on this relief, then you can check the special extension box in Part 1, Line D of the main body of the Form 5500 and describe the relief on the accompanying line. Also, the DOL announced that it would be initiating group health plan relief, and that announcement was made August 30th. And the DOL encouraged plans to make reasonable accommodations to prevent the loss of benefits if participants and beneficiaries fail to timely file documents such as benefit claims or COBRA election notices. So if you are affected, if you were affected by the Hurricane Harvey, then you would get some extra time to do those types of things, and the DOL would not come after you and enforce that and assess penalties. And finally, we should mention one of the big things that happened really from this was that the IRS came out and announced special tax relief for leave-based donation programs, and really sort of this is a way to help by allowing employer-sponsored leave donation to be tax deductible and not to count as taxable compensation to the employee. And it released guidance that provides that the cash payments employers make to qualifying tax-exempt organizations, and they have to be be qualified, and meet the requirements. It will be considered to be tax deductible, and it can be essentially in exchange for vacation, sick, or accrued PTO leave that their employees are going to forego, and that will not constitute income to the employees if the payments are made before January 1 of 2019 for the victims of the storms. And then they also clarified in this guidance that the mere opportunity to make a leave donation does not result in the constructive receipt of income under the constructive receipt doctrine. So very helpful guidance for employers. And then much more recently, beginning on September 12th and over the next few days, the DOL and IRS went about applying those same rules that were applicable under Harvey to the victims of Hurricane Irma. These new rules were designed to parallel those, and the tax relief postpones various tax filing and payment deadlines pretty much on the same terms and conditions, but now applying to Irma relief, and that occurs starting on September 4th of 2017 in Florida and September 5th, 2017 in Puerto Rico and the Virgin Islands. And it will, as a result, businesses will have until January 31st of 2018 to file returns and pay any taxes that were originally due during that period. And the extension also applies to the October 31, 2017 deadline for filing quarterly payroll and excise tax returns. So some good news there. I know for a lot of our clients and the businesses operating, our clients that are operating in Florida and the affected areas. And if you want a listing of the areas that were designated by FEMA as qualifying for assistance and that to which this guidance applies, you can check it out. It's on our website at www.corpsin.com/IRMA page, and it's actually there's a link there for you. So we definitely would encourage you, if you're in that region, to check out our website about Irma and to learn more about the relief that's offered. There's also going to be the same group health plan relief that would apply to Harvey to allow for reasonable accommodations that was announced on September 15th of 2017, and also the same leave-based donation programs that, these sort of tax-favorable leave donation programs that were applicable to Harvey are going to also be applicable to Irma as well. Okay, so I know we weren't supposed to talk about the ACA, but we wanted to give you this very, very, very brief update, a timeline really of what's been happening in the repeal and replace timeline, especially given how much has happened with the reform of healthcare reform. And we initially made a very brief timeline of the most major, or obviously what we thought were the most major developments. But then we decided, you know what, this is still a lot of material that most of you probably already heard about. So we decided to repeal most of our repeal and replace timeline, and we've added to the full timeline. We've added the full timeline to our appendix in today's presentation, so you can refer to it after today's webinar. And there's still lots of talk, lots of changes still happening, but we wanted to kind of update you from where we left off at our last webinar, which was in June, and talk about kind of what's been happening since. And a lot really happened at the end of July. And notably at the last presentation, we talked a lot about the Senate's ACA replacement plan, which was called the BCRA, and which was a lot like the House's version in many respects. And the key provisions of the BCRA were that employers would be relieved of having to comply with many of the ACA's most burdensome taxes and regulatory hurdles, including the employer mandate or the pay or play provisions, which would be repealed back to 2016. It would also repeal the individual mandate, and also the Cadillac tax would lapse and not be collected until 2026. Additionally, the BCRA would retain the House's new rules for HSAs and FSAs, meaning that there would be no contribution maximum to health FSAs. And with respect to HSA rules, you could contribute the maximum out of pocket on the high deductible health plan to the HSA. Also, HSAs would become much more flexible by allowing over-the-counter medication reimbursement and lowered penalties for non-qualified medical expenses. So a lot of great things in there in that BCRA for employers. And what happened was at the end of July, they started to make little changes to it. One thing that was added was called the Cruz Amendment for Senator Ted Cruz, who proposed that let's make skinny plans available on the exchanges. So that was added to the BCRA. And then there was additional money that was added for the opioid epidemic to the BCRA. So there were all these different little changes that were happening. But then they started to make revisions to it because they realized, oh wait, some of this stuff is not going to pass through the process of budget reconciliation, which requires under what's called the Byrd Rule that things that are not budget related have to be extracted from the bill, because the special process that they're using to repeal the ACA is the budget reconciliation process. This process where they take the things out that are not budget related is called the Byrd bath. So that really began on July 21st. We got a very different, shorter, cleaner version of the BCRA after it went into the Byrd bath. And then we really saw the beginning of the real debate that was happening in the Senate, which really kind of took place beginning on July 25th. And then in the Senate, they introduced the ORA, and the ORA is the Obamacare Repeal Reconciliation Act, and it's really just an updated version of a piece of 2015 legislation that would repeal all funding for the ACA's Medicaid and insurance expansion, but it would keep a lot of its regulations on insurers. And specifically, the big thing with the ORA for employers is that it would get rid of the employer mandate back to 2016, but it would also end the ACA's premium tax credits, cost-sharing reduction payments, Medicaid expansion, a lot more. It was essentially just like a big, hey, let's repeal first, or it was often referred to as the straight repeal. But the best way to think about it is big on repeal, little on replace, because that's pretty much the best way to describe the ORA. And the debate continued. The Senate voted no on the ORA on July 26th. The debate continued. July 27th, we saw what was called the Skinny Repeal Bill come out. And what was the Skinny Repeal Bill? Well, really a lot like the BCRA, essentially just a shorter version of the BCRA. It would have also eliminated the individual mandate, but it would only have eliminated the employer mandate for a minimum of 8 years. So, very close to the BCRA, but not as tough on the employer mandate. and it also would have defunded Planned Parenthood and given that money to community health centers, made some other changes, but essentially just a shorter version of the BCRA. It was voted, it was debated, and at the end of the day, there's still 3 senators who opposed it. Most famously, and you probably saw this on CNN, John McCain voted no in this very late-night dramatic no vote, which essentially killed the reform of health care reform, giving the Republicans only until September 30th, the end of this month, to come up with another replacement plan through the budget reconciliation process. And, really, at that point, there was a lot of bipartisan talk about things we can do to fix the exchanges, but really, for the most part, it seemed like it was too late, right? There was nothing that the Republicans could propose that would fix the problem. And we saw on August 28th and August 30th, the IRS went forward with 2017 ACA information reporting. So the IRS was continuing to release its draft forms, its draft instructions. And then on September 6th, we saw some interesting developments happen where we saw more bipartisan talks in the Senate Health Committee hearings on ways that we can really provide for market stabilization on the exchanges, continue funding the CSR payments, do things to help with making it easier for states to innovate with regard to the provision of health care. And then really the most recent development happened, which was that we saw on September 13th, Republican Senators Bill Cassidy and Lindsey Graham released the Graham-Cassidy Act. And this is what's considered to be the last-ditch effort, the last effort the Republicans have. And for purposes of employer-sponsored coverage, pretty much the same, this Graham-Cassidy bill, it's pretty much the same as the BCRA. However, it would have a very different take on provisions pertaining to funding of Medicaid dollars. It would give a lot more discretion to the states with respect to how they could use federal funds. But with the exception of those other things, for employers, it's really a lot like the BCRA. And really, it's too early at this point, since it just came out recently, to see if it will have enough votes. It's really not clear at this point if it will. Also the same day, we saw Senator Bernie Sanders introduce the Medicare for All Act of 2017, which would provide a single-payer healthcare system for the United States over a 4-year transition period. What it would do is it would expand Medicare to allow it to start covering more things like vision, dental, and hearing aids. And over that 4-year period, it would apply to gradually more and more people, so that people who were in the first year, those who are 55 or older could get Medicare, then 45 or older, then 35 or older, until every U.S. citizen would have an entitlement to Medicare coverage. Also, much like the Graham-Cassidy bill, it's probably way too, in fact, even more so, it's probably way too early to see if that kind of bill would ever get traction and go anywhere. And it really is just too early to say with these recent things that happened on September 13th. And finally, we have a nice little interesting, helpful, informative chart that shows you the CBO scoring results on what the impact would be in 2026 under all of the leading repeal and replace proposals from the end of July. Really interesting chart. And as you can see, the ORA, which is right there in the middle, which was that bill we talked about that was very big on repeal and very small on replace, it really takes the cake as the as the ACA replacement plan that leads to the most uninsured Americans at a whopping 59 million uninsured, or an increase of 32 million uninsured from where we are now. So very interesting slide. Just thought we'd add that at the end. So that's all for today, folks. Thank you for joining us, and please join us in November for our next Compliance Bootcamp webinar.
Great information, Dan. Thank you. Before you exit the webinar, please take a moment to complete the brief questionnaire that appears so we can address any feedback you have for us. Your SHRM PDC and HRCI credits can be downloaded now by clicking the certificate widget. Again, we will send out the presentation slides to all attendees by tomorrow afternoon. Any further questions can be sent to ashley.whalen@corpsyn.com. That's ASHLEE.WHELAN@CORPSYN.com. Thanks for your attention, and please enjoy the rest of your day.